In today's video, we are going to talk about one of the hottest yet complicated topics, the stock market. You might have come across someone telling you on news or social media that the stock market is falling and everyone is going down with it. Well, they are right about the first part. Stock market indeed took a beating, but we are here to tell you some of the ways you can save yourself, and not only that, how you can take advantage of the falling stock market. But before that, please make sure to subscribe and like this video if you want to be in the loop with the latest money tactics on how to increase your wealth. Okay, first, we need to understand why it is that the stock market is falling. A couple of factors are into play here. Number one, the illness outbreak threatens to drastically change consumer behavior, disrupt businesses, and thus short-term earnings outlook takes a beating. Number two, with no solution in sight to the pandemic crisis, investor sentiment has taken a hit. They are rushing to prune riskier bets amid continued pandemic recession fears. Number three, sustained selling by foreign international investors, mainly ETFs, amid a global risk aversion. They have sold stocks worth millions of dollars in only the month of March, and the trend continues. Number four, a nearly 50% fall in crude oil prices is also hinting for worldwide recession. Now, watching the stock market fall in real time can induce fear and panic, and that is exactly what happened in late February and March of 2020, as trading responded dramatically to the coronavirus pandemic. The S&P 500, an index that serves as a benchmark for the US stock market, fell almost 34% between February 19 and March 23, 2020. This crash is what is called a bear market in investment terms. A bear market is generally used to describe a downward market, but specifically, it is a market that has fallen by 20% or more from a previous high, lasting for a long period of time, usually 2 or more months. This occurs when the number of sellers outweighs the number of buyers, resulting in a pessimistic market sentiment. It usually refers to the overall market or an index, but individual stocks or commodities could also be said to experience a bear market. In current times, we are experiencing one of the worst bear markets, and some stock market experts say that this market crash holds uncanny resemblance to the stock market crash of October 1929, which triggered the Great Depression. Sounds scary, right? Well, the majority of the investors are scared too, and to some extent it does sound logical to be scared. When you're shopping for groceries and other goods, lower prices are generally viewed as a good thing, but with stocks, a huge plunge in prices sparks the desire to sell instead of buy. Why is that? Because when you're buying milk or bread from the grocery store, choosing a lower cost item saves you money. In contrast, a falling stock market essentially costs you money in the form of an investment loss, and that's scary, especially when retirement or other important investment goals are at stake. Till you sell, however, those losses are what are called a paper loss, which means they're unrealized and impermanent. A stock market recovery can cancel losses and return your portfolio to its original position, or even to a better one. If you decide to sell your stocks while the market is falling though, the losses aren't just on paper, they're now a reality. So, you might ask, what should one do when market is falling? Continue losing money? As weird as and risky as that might sound, this is your only option of a healthy recovery from this market fall. If you have money invested in the market, when the market crashes, here's what you can do to save yourself from permanent loss of money. At the start of a market crash, bear market, or even a more temporary downturn, it is important to not panic and follow the herd. While these downward price movements do have adverse impacts on portfolios, the extent to which you are at risk will completely depend on your goals as a trader or investor. For buy and hold investors, there isn't necessarily a need to fear a market downturn because you're interested in the long-term trajectory of the stock market. Bear markets do tend to be significantly shorter than bull markets, which is why the stock market has overall increased in price. For example, the FTSE 100 could fall in price by almost 4,000 points and still be at a higher level than it was 20 years ago, despite 2 bear markets in between. However, as we will explain in a moment, the risks involved in downturns will completely depend on the method you use to invest in them. Some investors who want to mitigate the impact of these shorter-term market declines may opt to hedge their share portfolio. But this strategy is dependent on risk appetite and available capital, as it involves opening multiple positions. For traders, downturns and bear markets offer great opportunities for profit because derivative products will enable you to speculate on rising and falling markets. By using derivative products, you can open a position on securities without ever needing to own the underlying asset. There are a variety of ways that both investors and traders can profit from market downturns, or at the very least, protect their existing holdings from unnecessary losses. These include short selling. Short selling is a fairly simple concept. An investor borrows a stock, sells the stock, and then buys the stock back at a lower price to return it to the lender. Short sellers are betting that the stock they sell will drop in price. If the stock does drop after selling, the short seller buys it back at a lower price and returns it to the lender. The difference between the sell price and the buy price is the profit. For example, if an investor thinks that Tesla stock is overvalued at $1,500 per share and is going to drop in price, the investor may borrow 10 shares of Tesla from their broker, who then sells it for the current market price of $1,500. If the stock goes down to $500, for example, the investor could buy the 10 shares back at this price, return the shares to their broker, and net a profit of $1,000 per share. However, if the Tesla price rises to $2,000, the investor would lose money. Dealing short ETFs. A short exchange traded fund, or inverse ETF, is designed to profit when the underlying benchmark declines. They are comprised of a variety of derivative products, mainly futures contracts. It is similar to shorting a security, except instead of borrowing an asset to sell, you are buying the market. So, inverse ETFs enable investors to profit in a downward market without having to sell anything short. For example, if you expected the FTSE 100 to decline in value, you might invest in a short FTSE 100 ETF. If the UK benchmark did decline in value, the short ETF would increase. Short ETFs are considered a less risky alternative to traditional short selling because the maximum loss is the amount you have invested in the ETF. Trading safe haven assets. A safe haven asset is a financial instrument that typically retains its value, or even increases in value, while the broader market declines. These assets are negatively correlated with the economy, which means that they are often used by investors and traders for a refuge during market declines. In theory, you would take a long position on a safe haven in order to prepare for market downturns. This is seen as an alternative to closing positions or going short, as it enables you to hedge any existing holdings. Common examples of safe haven assets include gold, government bonds, the US dollar, the Japanese yen, and Swiss franc. However, it is important for investors and traders alike to remember that just because an asset is traditionally considered a safe haven doesn't guarantee it will perform as such in every market downturn. If we take the example of gold, to invest in the safe haven asset, you'd be looking to buy the physical precious metal as a store of value. However, if you're just looking to speculate on the value of safe havens, you could use derivative products so that you didn't need to take delivery of the asset itself. Trading currencies. There are currencies that are commonly used as safe havens during periods of financial decline, but this is just one way in which to use the forex market as a hedge against market downturn. A national currency is dependent on the health of the domestic economy, which means that any perceived decline in the economy at large will play out in the price of the currency. If an economy is seen as weaker than other global economies, its currency will depreciate compared to other global currencies. For example, during Brexit negotiations, the political turmoil and instability impacted the appeal of investing in the UK. This saw volatility play out across the FTSE 100 and British pound sterling. Traders can take a position on the price of a declining economy by opting to a short currency, to shorting a currency, basically. When you trade forex, you're inherently buying one currency and selling another. For example, when you sell British pound to US dollar, you would do so if you believe that the value of the pound will fall in comparison to the US dollar. Buying at the bottom. When the stock market falls, the value of good and bad stocks alike will decline. However, the good ones will likely recover. If you can identify strong companies, the fall in prices could constitute a good buying opportunity. It is important not to rush in to buy the first stock you see, regardless of its reputation before the bear market. Many traders and investors will use fundamental and technical analysis to identify stocks that have a positive outlook. You should always look at the company's balance sheet, valuation, management strategy, and debt levels. Lenders will be looking at which companies are best positioned to pay off their debts and recover from the bear market. So, by assessing how creditworthy a lender believes a company to be, traders can identify good opportunities to buy at the bottom. Bond ratings of AAA, AA, and A indicate that a company is believed to be creditworthy, while anything below is considered a risk. Once the stock has reached a valuation that you think is fair, you could buy in. It is important to remember though that the share price likely will not bounce back immediately, but if you are confident in your analysis, you should be fairly well assured it will eventually. Now, the bottom line. Whether the stock market is falling due to a larger economic crisis or simply everyday volatility, take a step back to think about how you can take advantage of the situation. Create a strategy to diversify your portfolio, research your investments, and avoid trying to time the market. Also, understand how much risk you can take on based on when you'll need the money you're investing. And consider working with a professional to help you ensure your approach is effective and hopefully profitable. That's all I had for today. Thanks for sticking around, and I hope that this video was able to help you understand why the stock market has been falling and how to take advantage of it. If you liked my content, please hit the subscribe button at the bottom so that you can stay updated about all the new content I make regarding finances, investments, and the business world. Stay well and see you in the next one.